Good morning, everybody. This is the live market open for Wednesday, August 24th. I'm Yohay, Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. Hope everybody's doing well in this period of summer. Trading volume might be a bit lower. Volatility is not that bad. As always, we'll cover recent developments in markets, talk about various charts and levels, and focus in this show on two specific topics: the Jackson Hole Symposium that begins on Friday, Janet Yellen's speech, and a preview for the stormy September for Euro-Dollar. I believe, I have good reasons to believe that Euro-Dollar will go a bit wilder in September, which is actually just around the corner. Summer is about to end. And of course, we'll finish with preview for the next week, which is getting much busier as well. Okay, so what's going on in markets? The US dollar has been retreating throughout most of the month, but now it's making some kind of a comeback, okay? It is gaining a bit of ground. One of the reasons is the beat in the US new home sales reported yesterday, but there are also some profit taking and expectations for Jackson Hole Symposium. Maybe we'll hear something hawkish from Yellen or not. Still, markets are relatively relaxed. Equity markets are moving higher. Oil that had a very, very nice rally in August. Remember, just at the beginning of the month, oil prices, WTI crude oil, was trading very low, was trading under $40 a barrel, and now it's back up. But once again, it may have topped around 48, 49, and with the falling oil prices, we could see a stronger US dollar. Okay, there are lots of rumors about an OPEC meeting in September, an unscheduled one, or perhaps an OPEC meeting together with non-OPEC members such as Russia, of course. And there are talks about, will Iran be ready to cut oil production or not? Will Iraq do so or not? Mentioning oil because we do see a growing correlation between price of oil and the US dollar. Remember, it's an inverse correlation. Stronger oil, weaker dollar, weaker oil, stronger dollar. Okay. Another thing that has an impact on markets, we talked about this a lot last week, the Brexit. Brexit finally got some hard data from the UK, and it was all good. So Brexit was not a total disaster. Most importantly, retail sales went up 1.4%. This did positively impact the pound, but this didn't last too much. And another thing in markets is a growing debate about the Fed. Of course, will they, won't they, regarding rates, but also how much can they do, and what's the role of governments, and maybe they should change targets. Maybe they should set a higher inflation target of, let's say, 4 or 5%, or maybe target nominal GDP. That means allow perhaps for more inflation if growth is low, and the other way around. Anyway, that's just another theme in markets. Of course, we also have the politics in the United States, but this is relatively stable. I didn't even put it on the slide because Clinton maintains a solid lead. Everything is still possible, but we haven't seen many changes, and everybody's been watching the Olympic Games. I hope you had a good time watching them, but also this is over. Summer is about to end, and things are getting back to business. Let's look a bit at recent data and then look at the charts, of course, and see how the dollar is making a comeback of sorts. So last week, we'll take you back 1 week to the past. We were doing a big preview of the Fed meetings. So what happened with the Fed? The initial reaction was a stronger US dollar. Why? Because we learned that the one dissenter in the Federal Reserve, Esther George, the one dissenting voting member that wanted a rate hike, she wasn't alone. I mean, another member, at least, that isn't a voting member also supported a rate hike. But after a few minutes, when markets began reading the minutes, they understood, okay, there perhaps may be a vocal minority. Maybe they're banging on their drums, banging on the tables for rate hike, but they're a very small minority, and most Fed members want to wait and see, are not sure about growth, about international developments, about Brexit, you name it. Now, these were the minutes from the July meeting, but remember, they're revised all the time. So that sort of weighed on the US dollar, the meeting minutes. Other Fed officials, they talked in all directions about the need to raise rates this year, which is not a big surprise, but not now. Some of them wanted a rate hike now. Some of them wanted wait and see. So it was quite all over the place. Data, of course, UK, we had three key releases. Inflation figures came out better than expected, showing a big rise in PPI, especially. Employment, we actually saw in July a drop in the number of unemployed. That was good news. And the last piece of good news was retail sales that came out 1.4% month over month, much better than expected. And some said, okay, well, because in July there was good weather in the UK, it was sunny in the UK, something that isn't that common, and June was terrible, so it's actually weather related. But when you're saying that something is weather related and not Brexit related, it means that Brexit didn't have such a big effect. So even if we had a drop due to bad weather or a rise due to good weather, and we're talking about the weather, not about Brexit, that means that Brexit didn't have such a big impact. So business surveys, the soft data is very gloomy. Expectations for severe deterioration in the UK economy. But the hard data, what we've seen so far, at least in July, of course, it's an early reaction. It's not that bad. Okay, so things might still get worse. Good morning, Hans. Good morning, Adinda. Good morning, everybody. But so far, the few pieces of data we have from the UK are not that bad. Other things in our brief here, Canadian data, retail sales and CPI, really badly disappointed, but we're seeing the Canadian dollar move more on oil prices. Australian unemployment, that was a good piece of news. It fell to 5.7%, and also the number of jobless claims went up. Yesterday, we had a great leap in US new home sales. They jumped to the levels last seen in 2007, before the recession, before the great financial crisis, the crash. But we've been there before. 3 months ago, we've seen a jump in new home sales, and that was revised eventually lower. So we already passed the 600,000 mark, and then it was revised lower. Let's see if this time it holds or not, or if it's a one-off jump, and then we're falling back under 600,000. So still lots of grains of salt here, okay? And yesterday's Eurozone PMIs were mixed. Okay, enough talk about the data. Let's look at the charts, euro dollar. So euro dollar in the past week or so, since our previous show, did make a nice move to the upside, continued higher, broke above this 112.30 level, and so far did not look back. We reached the top of 113.65 over there, almost 70. Since then we had a drop back to the 112 level, another move to the upside. We're seeing sort of euro dollar exhausting its rally. It seems the pair is struggling to move to the upside. It seems to be at crossroads. So finally, it did get out of the frustrating range of 111, 112, and went to levels, new post-Brexit highs. So if we zoom out to the daily chart, we did see some kind of move to the upside. Okay, this was a more frustrating range. You went one step higher, again got stuck in consolidation. But I think that we are seeing some bigger moves in euro dollar. The pair finally woke up. But will it go higher? Will it challenge the post-Brexit highs here of 114.20 or even higher, or fall back down? We still don't know. We'll have a focus on euro dollar, but in any case, 112.40 and 113.60 are currently levels to watch. Okay. Pound dollar, as I said, we did see it recovering. So finally some hard data that helped it escape the lows of late July, not the 31-year lows seen immediately after Brexit at the end of June, but we did see these lows earlier in the month. And then more good data and weakness from the US dollar. So we did see the pair climb higher. Currently it's at 131, sorry, 131.66, 130.60 is support, 132.50 is resistance. So we did recover, but I would say that it's still mostly related to the weakness of the US dollar, a bit reversing itself now, but it wasn't fully taking advantage of the good UK data. So I would say that it's still wary of markets. The pound is still sort of hated, if you wish. I mean, we're still wary of the Brexit implications. Anyway, 130.60 to 132.50 further resistance 133.60, and further support, of course, the round number of 130, and then 128.40. Let's continue with dollar yen. Also here we had a struggle. So the 100 line has been a tough nut to crack, as they say. We did fall below this line, but it's still a battleground. 125 is the current level. We did rise and almost reach 101, but we're a bit more confined above 100. Perhaps markets are a bit afraid of the Bank of Japan. They might intervene. They do not like each time the pair falls under 100. They are watching closely FX levels and using other kind of language to say that they don't like it, but they aren't really intervening. Let's add some lines on the chart. We are seeing a more constrained level. So markets which were defying the Bank of Japan quite a few times this year are now a bit more scared, I would say. 99.60, some kind of support. 100, of course, the round number. Well, these lines might be a bit out of date. We're seeing a bit more choppy action here. So 180 is the line to watch. And then on the top, 101.50, okay? So things are a bit more balanced. Yes, we have dollar weakness. Yes, we have markets wanting to go for the safe haven yen, but a bit more balanced than it used to be. Let's continue. Dollar CAD currently, the greenback vs the loonie at 129.40 under the 130 level. 128.30 and 127.50 work both as support. We did see this big deterioration here from the highs all the way down. This goes hand in hand with the rally in oil prices. So the Canadian dollar did ignore weak job figures, weak retail sales, weak inflation figures, and did ride alongside oil. But 127.50 was already too much, and we're going back up again. 130, 130.80, and 131.40 are lines of resistance. Support 129.10. Look at this chart. Now look at the mirror image more or less in oil prices. WTI crude oil moving to the upside now. It fell from grace. Okay, so this is what I mentioned before. Just at the beginning of August, okay? 3 weeks ago, not that long in not ancient history, we traded in WTI crude oil under $40, reached 39. We had a first attempt to move higher. It was blocked, got stuck, and then another move went up and up and up and up. Reached almost $49. Now we're back in lower ground. I don't see reasons for oil prices to rise because supply is still high. U.S. shale production is moving up. The Saudis always want to pump more. Also Iran, Iraq, Libya. There may be some kind of production disruptions, but all these countries do not trust each other and want to pump out as much oil as possible. Anyway, for WTI crude oil, and this is of course relevant for the loonie, 47 is support, 48.30 is resistance. Okay. Aussie dollar. Also here, we did get some good news from Australia. Chinese figures were not that bad. And more importantly, Australian employment is going up, unemployment is going down, but still, it did sort of, Aussie dollar went higher thanks to the weakness of the US dollar. And when this weakness fades out, also the Aussie dollar fades and goes down. So currently we're dipping under the 76 level. 76.60 is resistance, support at 75. Quite a popular currency pair, and for good reasons. Of late, it has been a bit more choppy. And let's update the lines here. So 75.80 is support, 76.40 is resistance. Okay, these are clear lines to see. Some other lines may be a bit more choppy. Okay, 77.40 is a resistance, followed by 77.80 and 78.40. To the downside, we still have there the 75.30 and 75 levels. Okay, so, but currently the range, as I said, 75.80 to 76. Sorry, that would be 76.50. Okay, so this is the 70 pip range we are currently at. Kiwi dollar. Also here we had a struggle to move higher. Look at all these attempts. So we had here sort of a false break above 73.30. So actually this week, Kiwi dollar reached the highest level in 14 months, but that was only temporary, only a false break. Also, this currency pair usually enjoys good technical behavior, but not this time. 72.60 is support. Look, it has been resistance back here in early August, now works as support. 73.30, despite the break higher. You know what? Let's update the because we've seen these levels over and over again. Let's put it at 73.40. So this is the current range, 73.40 to 72.60, and lots more room to the downside. Also here, the pair has been struggling to rise. Moving to other pairs, dollar Swiss 96.40. Always for many months worked as a good level of support and also resistance. And also today, it seems to slow the pair's rise. Okay, so the US dollar is recovering, but not going anywhere fast. Support at 95.50 and 95. Resistance above 96.40 is at 97. Okay, Swiss franc is not my favorite currency because there is lots of intervention by the Swiss National Bank. And most of the intervention is here on Euro Swiss. Again, at the 108 handle, 108.80 at the moment, a bit higher. There is some kind of invisible floor under dollar Swiss because each time Euro Swiss, each time it falls lower ground, there is some support from the Swiss National Bank. 110 is sort of, it's hard for the pair to maintain levels above 110, but also 107.60 is some kind of support. Okay, so Brexit did send it lower, but that was only very temporary. They actually did admit intervention around Brexit. Euro pound, 85.74 at the moment, also falling off the highs because the euro did lose some ground and the pound did recover on these, the good figures from post-Brexit period. Currently, I would say 86.40 levels of resistance. Basically, we're at much higher ground than before Brexit. So it does mean that vacations here in Spain have become more expensive for Brits, but visiting the UK has become cheaper. Here we are, and basically we had the big Brexit leap, then consolidation. We didn't reach 80, and now we move back up. Well, in a small correction here in range. Euro yen. I know it isn't such a popular currency pair, but still a very among retail traders, but it is a popular currency pair in the world because these are two very traded currencies. Currently at 113.24, very much in range in the past few days. 114.50 is resistance. Support there, I would say 112 and then 110.50. Let's go back to the hourly chart. And one of traders' favorites currency pairs, pound yen. So here also we had a nice move, of course, a nice crash. Post-Brexit reached this low of 113.10, fell to even lower ground, 128.50, and now we're balancing ourselves back here in range. 132, 133.10 remains resistance. I would say 130 is support because it's a round number, of course. Okay, and also served as support right here last week, actually. Okay, so this is relatively subdued range for pound yen. We got used to much bigger swings in the dragon. Okay, and we talked about oil. Any questions? We'll move to more events soon. Okay, so we did our run of the mill of currency pairs. Well, if I already passed through this screen, these are the chances for a rate hike in September according to the CME FedWatch tool. So they did improve. So now there's a 21% chance according to bond markets for a rate hike in September. It was up from around 10%. I still see the chances as 0, but we'll talk about that later on. And November, of course, it's 1 week before the elections. Forget about it. And December, it's already a small majority, over 50%, 50.6% for a rate hike in December. I would say 50-50, depends on so many figures, depends on who's elected as well. Okay, let's continue. We talked about the data that we had. Let's talk about the data that we have today. Not too much on the agenda today in the European morning, basically nothing really of high importance. At 2 p.m. GMT, we have the US existing home sales. Most sales of homes are of existing homes, second-hand homes, but the figure that moves the markets more is usually new home sales, because a sale of a new home means building the home, means more economic activity. Nevertheless, this will be watched. And we have the crude oil inventories. I'm mentioning oil once again because of the inverse correlation with the US dollar. So it's not only about the Canadian dollar. Tomorrow things get a bit busier. We have the German IFO business climate. I'll mention that was an interesting reaction in terms of German business surveys. We had the ZOO indicator fall to negative ground in July, reflecting sort of high anxiety regarding Brexit, but the IFO one remained stable. Now ZOO went back up to positive ground in August when the dust settled. Let's see if also the IFO one continues higher. It could support the euro, because the IFO is Germany's #1 think tank, okay? And also tomorrow we have durable goods orders, very important as well, because this reflects investment and feeds into GDP data. And that's a warm-up for Friday. On Friday we have GDP in the United States, a second release. Actually, expectations are quite low. So if you remember, in the first release, we had a very, very disappointing number of only 1.2% annualized growth. And now it's expected to be downgraded. The projections are for 1.1, so a very poor number. But it's a second release. It's not as important as the first one. We also have revised GDP in the UK. Less important because, GDP is important because it's the overall report card for the economy. But on the other hand, it's for Q2, and that was pre-Brexit. And in addition, it's important to mention that revisions in the UK are not that common. But the big event, of course, is Yellen's speech in Jackson Hole. I'm not sure it's going to be at 2 GMT. Some calendars show 2 GMT, some don't. But anyway, we'll do a preview for that. Jackson Hole is the next thing on our agenda. It's true. Okay. Any questions? So this is a preview for the Jackson Hole Symposium that begins late this week, goes on over the weekend. So Jackson Hole is a beautiful place in Wyoming, the United States, surrounded by snow-capped mountains, green fields. Really, all the pictures I've seen from there, I've never been there. Looks like a beautiful, calm place. Every year at the end of August, the Kansas City Fed, holds a long weekend of discussions with senior central bankers. This includes usually the chair of the Federal Reserve, although Janet Yellen skipped this event in the past. But this time she'll be there and she'll provide a speech, and other senior central bankers from the United States and from abroad will be there. Okay, some of them will give speeches, and it's an opportunity for them to talk and to also send some messages. Okay, but some of the speeches are more academic. Some of the data is unfortunately not leaked to the press, and we don't know everything that's going on. So this also leads to some conspiracy theories about what did they actually agree on. If we're seeing some kind of move in markets, maybe it's actually what they plan to do. I would discount these rumors. But anyway, this is a chance for central bankers to provide some messages. The biggest examples were from Ben Bernanke, the former chair of the Fed. In 2012 was, I think, the biggest opportunity. He laid out the prospects, what he's going to do in the next meeting in September and at the end of the year in December. So these were huge events, and markets are watching. Yellen in the past either didn't say anything important or didn't even show up. But this time, there are expectations that things will be different for several reasons. First of all, markets are a bit confused with data. So the good data from the United States, if to put it in a simplistic way, is the good non-farm payrolls. Remember, 2 good months, 292 in June, 255,000 jobs gained in July. Wages are rising, the unemployment rate is low, everything looks good. Housing also, building permits housing starts released last week were good. New home sales released yesterday were even great. That's all positive. On the negative side, we had yet another disappointing retail sales report, and consumption is a very big part, about 70% of the US economy. And GDP data looks bad. We had 3 consecutive quarters of annualized growth of just around 1%. Very poor. Remember, in quarterly terms, that means around 0.2, 0.3, 0.4 if I want to be really generous. And for the United States, this is not good growth, okay? And in the middle, we have inflation just not going anywhere fast, healthier than here in Europe, but 1.6% in the Fed's favorite figure, the core PCE price index. It's not going anywhere fast. The US economy, if we look at inflation, is not really heating up. Now, I think that regarding September, we should lower our expectations, and there could be even just one reason, okay? US elections. It's heating up. We had the Olympic Games, we had the conventions, then we had some quiet, we had the Olympic Games. But now, especially after Labor Day passes and we get closer to the debates between Donald Trump and Hillary Clinton, the race is heating up. The Fed, regardless of the candidates, actually, does not want to be part of the debate, okay? So Clinton is the incumbent. And Trump is all in for low rates. So if the Fed raises rates in September, it'll be bad for Clinton. They'll get angry. Okay, the Clinton campaign can get angry with the Fed. And if they raise rates, which is not what Trump advocates for, they'll get angry as well. The Fed does not want that kind of stuff. That's one reason not to raise rates. The bigger reason, perhaps, is also that the Fed is dovish, okay? Janet Yellen always errs to the side of the dovishness of the Fed. Also knows, I mentioned a lot of debate about the Fed. They miss their growth forecasts time after time again. Expectations are always set high and reality is lower. So why take a chance in raising rates, okay? So my expectations are high. What we don't know, and what I've shown you before, is the 50-50 chance, according to bond markets, for rate hike in September. I believe that if the data continues to be as it is, basically okay, mostly okay, good enough, the Fed and Clinton is elected, more continuation, and of course Republican control of the House. I mean, more of the same, no changes. The known knowns, if you wish. The Fed can raise rates in December. It's a good time to raise rates, close to Christmas. People are getting on vacation once again, and it's the lame duck session. It's the 2 months between the elections and until the new president is sworn in. So that's a good chance for rate hike. They also have fresh forecasts in December, like now in September. So, but if things go wrong, if Trump is elected and we don't know what's going to be the future, and if the US economy deteriorates, I think things can get worse, and then they will not raise rates. Anyway, in September, I think the chances are low. But even though the expectations, at least on my side, are low, and I'm not the only one, some think she will hint about rate hike in September because some of her colleagues want a rate hike. This creates a bit higher expectations, but I think in general markets don't expect anything in September. Now, apart from rate hike in September, maybe the Fed will change its policy in the future. Maybe she'll throw in things like nominal GDP, inflation targeting of a higher level, or things like that. And even though expectations are low, there is still lots of hype in markets. If you watch financial television like Bloomberg or CNBC, there's lots of talk about it. And there's low volume. We're at the end of August. Many people are on vacation. That means that any headline that comes out from Yellen, either correctly interpreted or wrongly interpreted, can make big splashes. Okay, so it's a small stone can make a big splash because volume is low, and it's also Friday, and traders are trying to square some positions towards the end of the week. So all in all, I think the event itself, where it held, on a weekday in July, it would be just another speech from Yellen. But this time, with all this timing, late August, Friday, close to the end of trade, and with all the noise about this, and with not much to talk about, I think it could be quite momentful for markets. Remember, even if the Fed remains dovish, which it is, it doesn't mean that the dollar is going down. Okay, because the Fed or the US dollar remains the cleanest shirt in the dirty pile. The ECB is considering more moves. The Bank of Japan is considering more. The Bank of England faces Brexit and is set to cut rates once again in November. So the US dollar is still on the path, on the very slow. They go as slow as possible, as gradual as possible, but they're still heading towards a rate hike. Even if it's not December, it can be early 2017. So even if we get perhaps a short-term dollar squeeze on very dovish speech from Yellen, it might not last very long, okay? All right, so what else do we have for you? Okay, our second special segment for today is Eurodollar Stormy September. Okay, so Eurodollar did begin moving out of range, but the moves are still slow. Let's begin with the problems in Europe and how they're boiling a bit on the back burner, but they could come back to the forefront quite soon. First of all, there's speculation about the ECB. Will they do more or not? Let's add the date here. It's September 8th, okay? That's when they meet. And this meeting is important. Why? Because they have new forecasts, like the Fed does every 3 months. So there are more important meetings and less important meetings. This is a more important meeting. Secondly, traders are back from vacations, and the hype will be even higher, okay? Then what else can they do? Cut the deposit rate by another 10 basis points? Possible, but the only reason for doing that would be to be able to buy more bonds, because they have a limit on buying bonds. Bonds that have yields lower than 0.40, minus 0.40, are ineligible for ECB buying. Will they add more QE, but they're running out of stuff to buy? Will they do something else? Will they say, okay, we're done, and governments need to do more? So lots of speculation, and I believe this will cause action towards the event on September 8th and afterwards. Of course, we'll talk more in detail when we get closer to the event, but this is a big ECB meeting. Secondly, there's more uncertainty about Brexit. Remember, it's not only the UK leaving the European Union at some point, but also the European Union left out, and they don't know exactly what to do and how it'll impact them. So, and now we'll get more and more data at the beginning of September regarding that. Italy is sort of rebelling, okay? Italy, the third largest country in the Eurozone, they have a referendum in October about changes to the constitution. It's actually a referendum about the future. Also, a referendum about the future of the current Prime Minister, Matteo Renzi. And they began rebelling about the austerity policy. They're not much in favor of it. And finally, they began speaking up. At last, also, they have severe problems in the banking system. It's Monte dei Paschi, but it's also other banks. Lurking in the background, the stress tests didn't calm down any nerves, okay? So there's still a lot of worry over there. And, unfortunate news from this morning, there was also an earthquake. So lots of trouble in Italy. And this is the third largest country. The fourth largest, Spain. Still ongoing political uncertainty. I wrote here uncertainly. Anyway, so we had 2 rounds of elections here in Spain in December last year and in June, and still no government. There's going to be a debate about new government in Parliament next week, but it's unclear if we'll have a new government. If not, perhaps new elections around Christmas. Okay, even the Christmas Day is suggested as an election day. That's the fourth largest economy. Let's go back to number 2 and number 1. elections are already, in France in the spring and in Germany in the fall of 2017. In France, it's actually the campaign began this week with the announcement of former President Nicolas Sarkozy that he's running once again. He has to compete in the primaries. And so it has an impact on policy making. Okay, but let's stop talking about politics and also why Eurodollar is important in another sense. Uncertainty about the Fed. We talked in the segment about Jackson Hole, about the Federal Reserve, okay, and their decision. Will they hint about anything or not this week is an open question. But anyway, the decision is on September 22nd, exactly 2 weeks after the ECB. Also, also something that will move Eurodollar. Okay, another thing to mention is the euro served as a safe haven currency in 2015. It was a big change from serving as a risk currency. Will it return to be a safe haven currency? This remains an open question. Another thing why I think September will be exciting for Eurodollar is that September has usually provided action for this pair, at least in the past 2 years. In last year, it tumbled down in September after a very strong rally in August following the Chinese stock market crash. And in 2014, when the ECB announced further cuts in rates and began hinting about QE, it also tumbled down quite bad. Will it tumble down once again, or will it move higher? I'm not so sure. I think the ECB is close to its limits, okay? The Fed is not going to hike in September, so it might turn out to be a positive move for the euro. But again, we have political problems in the Eurozone. We have perhaps the ECB will do more, and it's too early to say. I don't have a clear bias at the moment. Don't worry. Once we reach September, I'll have a clear bias. Again, I may be wrong, I may be right, but anyway, what's more important is to look at the levels, perhaps at this point. So Eurodollar currently 112.95, 112.40 is some support, 111.90 the post-Brexit high. A few more lines here, 111.50, 110.50. Of course, the post-Brexit low of 109.05 is very strong support. If we zoom out, okay, so all in all, the ranges have been quite steady. So below this line, we have 108.20. This was the March low. Eurodollar fell all the way to that level when Draghi announced all the new measures, but then shot higher when he said basically, for now it's enough. Later on, he said, not so sure. Below this level, 107.20, another stepping stone to the downside. And the level seen in December, 105.20, also another Draghi disappointment. Another time the expectations were high in the sky and the reality was much weaker. And the last line is 104.60, which was the 13-year low seen in March last year. Looking up, 114.20 is the post-Brexit high, followed very, very closely by 114.60, which is 1,000 pips below that, above that 13-year low. And then 116.16, the high for this year, 116.16, the high for 2016. And above this line, we have the 117.12 level, which was the peak of 2015. And if we shoot even higher, of course, the round number of 120 is a good line to watch. Anyway, I'm happy that Eurodollar did wake up. It's still rubbing its eyes just a bit. It's still a bit sleepy. I think, though, we should be prepared for the big events in September. First and foremost, and the biggest events are September 8th, ECB meeting, September 22nd, the Fed decision. But in between, all the speculation, all the data, Eurozone inflation figures, US retail sales, political developments in Italy towards the referendum, political developments in the US towards the elections, everything is heating up and volumes are coming back. Okay. Now let's do a preview for next week's events. So this is a preview for the week of August 29th to September 2nd. It's the week that is the end of the summer, okay? Maybe not the sort of official summer and the end of September, but end of summer vacations, and that's what is important for us in markets. So in the weekend, we still have the Jackson Hole Symposium. We have the speech by Yellen probably on Friday at 2 p.m. GMT, but we'll have the whole weekend to digest it. So this will have an impact on the opening on Monday in Tokyo and then in Europe. In addition, we have very few pieces of data on Monday. We have the Fed's favorite inflation figure, the core PCE price index, but it'll be mostly about understanding what she said and what she did not say in Jackson Hole. On Tuesday, we have German and Spanish inflation figures, sort of a warm-up for the full inflation figures, and the US CB consumer confidence. Soft data, a measure of what sort of consumers did in the month of August. Projection. Things get much warmer on Wednesday, last day of August. It's the Eurozone inflation figures, preliminary for August. ADP non-farm payrolls, always a big hint for the US non-farm payrolls. Canadian GDP. Let's see again if we continue moving, if the Canadian dollar moves with oil prices or on its own. And of course, oil inventories amid higher speculation towards that OPEC meeting, which is unclear if it'll happen. On Thursday, September 1st, we have Chinese PMIs. As always, world's number 2 economy, watched by many. UK manufacturing PMI. Has the mood in the manufacturing sector improved in August or not? Okay, in July it was very, very poor. Has the soft data caught up with the hard data, or does the soft data manufacturing PMI reflect things are going to get worse quite soon? Okay, in the UK, US jobless claims on Thursday as well. Another hint for the NFP, well, small one. Bigger hint is the US ISM manufacturing PMI on Thursday as well. We do not have the ISM non-manufacturing PMI before the NFP this time, so it'll be a bit more speculative. Less data, smaller buildup, more a chance for surprises, and that's of course on Friday. Another input for the Fed. Remember, the Fed has 2 mandates: inflation and employment. We get employment here and also a bit of inflation through wages. And as always, non-farm payrolls is a big event. Okay, so that's the preview for next week's events. Let's take another look at the charts. Okay, I told you the euro dollar, I told you the US dollar is recovering. Very, very limited manner, almost erased. Markets are relatively stable. Okay, let's do the wrap up. This is the wrap up for the live market open for Wednesday, August 24th. All in all, we're still in summer mode just a bit. US dollar in general is having a bad month, but is finding some stability at the moment. The mood is relatively relaxed. Oil prices begin topping out after an amazing month so far, rising from below 42 above 48. And we're seeing a grower correlation, an inverse correlation between oil prices and the US dollar. Post-Brexit data looks okay, but the pound is sort of failing to capitulate, to take advantage of this, to take advantage. Anyway, there's also a growing debate about the Federal Reserve. What's its role? What will it target? Why is it so bad in forecasting? And that leads us to the main event of this week, of course, the Jackson Hole Symposium. Before that, the Fed, talking about the Fed, we had the Fed minutes. He showed no rush to raise rates. We have a vocal but very small minority of Fed officials wanting a rate hike soon. UK data looks good. Canadian data doesn't look good, but the Canadian dollar is a slave to oil prices. Australian unemployment rate falls to 5.7%. Good news, but also we aren't seeing the Aussie rallying hard. US new home sales, yesterday we learned that they leaped back to levels last seen in 2007, but we should take it with a grain of salt. We've already been there in the past. Okay, agenda for today, relatively light calendar, existing home sales and crude oil inventories. Sort of US dollar focused. Tomorrow, the German IFO business climate. Let's see if the mood continues improving in Germany. This could support the euro. And durable goods orders, important for the Fed, important for investment for the longer term. Friday, it's a very busy day. We have an update on UK GDP at 8:30, GDP in the US, and Yellen speech in Jackson Hole. We had a long preview, but let's just say that September is probably not the month to raise rates, but she may lay out her vision, her view on the economy, and the speculation low volume and in the summer and on Friday could mean quite a bit of action, even if she doesn't say anything. But it'll be closely watched. Okay, let's look at the charts. So euro dollar currently 113, not going anywhere fast. 113.60 resistance, 112.40 support. Pound dollar when just under 132, 132.50 resistance, 130.60 support. Dollar yen, well, hardly moving at all, above 100, a bit shy in falling under 100 again. 100.80 is resistance, low support 96.60. Dollar CAD 129.20. Looking for the next hint from oil prices. Support 129.10, resistance 130. Aussie dollar currently at 76.10. Support 75.80, resistance 76.50. And the Kiwi dollar made a false break to the upside. Support, anyways, 72.60, resistance 73.40. Let's see if it can find a chance to move higher once again. Okay, so that's our show for today. Remember, a big event is Jackson Hole, more important than GDP. And can always, as always, watch the full show and the special segments. Today we had a special segment about the euro dollar and the stormy September that awaits it. And you can watch it all over again on FX Street. It will be available later on today. It will be available also on Forex Crunch. I also mentioned live coverage of the GDP on Friday. Valeria Bednarik, Mauricio Carrillo, and myself will be covering it. Friday, the event itself, the release is at 12:30 GMT. We'll begin with the preview a few minutes beforehand, I guess about 12:15 GMT. Anyway, thanks for everybody that came. I hope, well, not too many people today because it's summer. Hope you're enjoying your vacations. Wish everybody a safe and successful trading day. See you either on Friday or next week. That's it for today. Thank you and bye-bye.